Well, welcome back. It's time now for the Word on Wall Street. Top investors watching your money. Joining me now is Janney Montgomery Scott, Director of Research, Christopher Marinac. Also with us is Mark Tepper this morning. Great to see you, Christopher. Thanks for joining the conversation.
Thank you, Maria.
And markets are higher this morning. Take a look at futures with the Dow Industrials up 40 points and the NASDAQ bouncing back after all the major averages were down yesterday. The NASDAQ now up 196. We're waiting on more earnings, Christopher. Goldman Sachs and Morgan Stanley's fourth quarter numbers will be out any moment. We will have the breaking news and check for market reaction. But so far, it's been a mixed start to the bank earnings season. Results from Wells Fargo, Bank of America, Citigroup all showed steady performance, but little signs of accelerating growth. The guidance is in line for the most part, not strong enough, though, to spark a reason to buy these stocks. Investors are pressing for greater efficiency, top-line momentum. What are your thoughts on the beginning of earnings season, and how are you allocating capital today?
So I look at the banks as doing well on revenue growth, and credit quality has done, I think, exemplary. We don't see any major shift in credit losses this year. I think that's super important. Credit is always job number one for any financial institution. I think the market's reaction is really muted because the stocks had such a great December and an early few days of January. So I'm not surprised that the stocks have sold off a little bit on the news, or at least are slowing down. I think there's a bigger opportunity in some of the mid-cap and smaller banks to catch up with the biggest. But I think that overall, the outlook is still good. I think most of these companies know it will be a volatile year in the marketplace. And so they're kind of honing in their expectations to be careful. But ultimately, I think it's still a very positive year.
All right, let's get to Cheryl, because Goldman Sachs numbers are out. They are just hitting the tape. We want to get the breaking news now. Cheryl.
They beat on earnings. They missed on revenue, Maria. They came in at 14.01 on earnings per share. The street was looking for 11.67. They did miss slightly, though, on the revenue, 13.45 billion. The street was looking for 13.79 billion. We'd seen some of these estimates actually jumping on the banking sector in general going into all of this. But this was deal-making activity and, of course, the trading desk. In fact, their investment banking fees came in, on estimates, 2.58 billion. And they also offloaded their Apple Card business over to JP Morgan. So that was actually a boost for them. They're saying that they are seeing high levels of client engagement and acceleration into 2026. A little bit of a loss on headcount, but overall, the company's saying provision for credit losses, a net benefit, 2.12 billion. And they're also talking about a dividend increase here, a quarterly dividend increase. They're going up to $4.50 a share for the first quarter of 2026, Maria. So, again, Goldman Sachs, the stock is actually moving just a little bit higher. As you mentioned, though, it has been a little bit of a mixed picture for the banks. And I think there's been some valuation concerns as well. We have Morgan Stanley. Let me give this to you really quick, Maria, while I've got you. EPS is 268. That is a beat. The street was looking for 244. Revenue 17.9 billion, and that is a beat for Morgan Stanley. So a double beat for Morgan Stanley, a miss on revenue for Goldman. Investment banking activity again and global markets strong for Morgan Stanley, as was strong for Goldman Sachs, Maria. We'll be looking for some comments from CEO David Solomon in the next few moments as well. Back over to you.
And I'm wondering, Cheryl, if David Solomon is going to talk about the loss of the Apple Card. Obviously, it's going to JP Morgan, that transaction happening in the fourth quarter. So I don't know if there's going to be any noise around that in the Goldman quarter. Goldman shares are up. Morgan Stanley shares are up 1 2/3% on these numbers. And I want to get your take, Mark Tepper, about these financial earnings and your sense of these earnings so far.
Well, I'll tell you, probably the two biggest issues for the bank so far has been this speculation that net interest income and margins may have peaked just due to the movement of rates over the course of the last several months. So that's probably the number one headwind. And also this 10% credit card interest rate max as well is working against them. But everything else I've heard is very positive. Investment banking revenues, trading revenues, wealth management revenues, those are all strong, and guidance is strong as well. So the banks are, in my opinion, they're doing very well, but they're also, in their earnings calls, they're giving us a lot of feedback on how strong the consumer is. The consumer is completely underestimated, and all of these banks have come out and essentially said the consumer is incredibly resilient. Delinquencies are not on the rise, and that's important.
Yeah, and of course, we were going to talk also about the tariff situation, Mark. The president imposing a 25% tariff on certain foreign AI chips, but he's exempting any chips that are being used to support the build-out of data centers and the American supply chain. But China is reportedly drafting new purchase rules for advanced AI chips, including that NVIDIA H200 chip, potentially limiting how many chips domestic companies can buy. Mark, your reaction to what we're seeing in terms of the tech sector this morning?
Well, I believe Gordon Chang said it earlier, and I'll repeat it because I believe this is definitely the case. But the H200 is NVIDIA's inferior chip. China probably wants the Blackwell chip so they can steal that technology instead. But the fact that China's even talking about these restrictions really shows you how important NVIDIA is and how technologically advanced NVIDIA is when it comes to their chips. Now, kind of stepping back and just looking at, chip makers and the tech sector overall, I'm looking at the, year-to-date sector leaders. And Maria, we're only 15 days into the year, but I can't tell you the last time I saw tech in the bottom two year to date. And we are being led right now by energy, materials, and industrial. So cyclical sectors are carrying the stock market right now, which is great. And I think a lot of the issues surrounding the tech sector have to do with things that you and I have been talking about now for at least 3 to 4 months, which is this expectation that all the CapEx spending that has happened over the course of the last few years has been given a free pass. Going forward, there's going to be more investor scrutiny. The investors are going to be wanting to see some sort of an ROI on that CapEx that's being spent, especially now that these companies are going to have to pivot towards actually raising debt to continue spending at those levels.
Yeah, great points all around. Christopher, your thoughts on these earnings here this morning? Goldman Sachs on the Apple Card portfolio markdowns. They are talking about $2.26 billion in the fourth quarter. Net revenue is obviously coming in at $58.2 billion for 25. That was 9% higher than the year earlier, reflecting higher net revenues in banking and markets divisions. Your thoughts, Christopher?
So I think Goldman has struggled on the banking side for several years. So exiting the Apple business is good for them. My sense is that there's going to be better trading on the investment banking side. And frankly, I think there's also opportunities for them to find new business from the trading side and investment banking. I think the bank piece for Goldman has been commercial driven, and that the Apple, lack of success there is good for them to move on, get those expenses out. So the noise here is normal. The important thing, I think, for Goldman is, can they really grow their other channel within commercial business, get commercial funding, and continue to be a player? The wealth management business may be the unsung hero, and I think Morgan Stanley's wealth management business continues to be excellent, and that is one of the key reasons why they continue to beat earnings every quarter.
Yeah, and it was a beat, and it was offset by the lower net revenues in the platform solutions business, which, of course, reflected that reduction in net revenues of $2.26 billion from the markdowns on the outstanding credit card portfolio related to the transfer of the Apple Card going to J.P. Morgan instead of Goldman. Christopher, do you want to own stocks in 26?
Absolutely. I think that we still have a really good economy. I think that strength is going to be important for financials and other economically sensitive industries. I think interest rates are very favorable for these companies. Even if the Fed's not going to change as much as people want, it's still very good for margins. And the ongoing, limit of higher credit costs is very important for these stocks.
All right, we'll keep following that. Mark, we're going to take your temperature on all of that coming up. I know you've been bullish all along and have been spot on. Christopher, good to see you. Come back soon. Mark, you're with us all morning long, and we're grateful.